If your investment portfolio has more moving parts than your TV remote has buttons, this video is for you. Because here's the truth, nobody wants to say out loud. Most people are not losing money in the market because they're underinvested. They're losing because they're overcomplicated. They've got 14 ETFs, 4 overlapping index funds, 2 stocks they bought on a whim, and a bond fund their uncle recommended in 2019. And they're still underperforming the guy with 3 funds and 0 stress. So today we're going to fix that. I'm going to show you the only 3 ETFs you actually need in 2026. One to anchor your money, one to accelerate your growth, and one to pay you while you wait. And at the end, I'll show you exactly how a regular person investing just $10 a day could turn that into over $1 million. No gimmicks, no crypto, no luck required. Let's get into it. Before I give you the 3 funds, let me explain why 3 is the magic number. The 3-fund portfolio concept was originally popularized by the Bogleheads, a community of investors who follow the philosophy of Vanguard founder Jack Bogle. The idea is simple. Own the whole market, stay diversified, keep costs low, and let time do the heavy lifting. It works. It has always worked. And in 2026, with markets pulling back, tech volatility creeping back in, and a lot of uncertainty in the air, it works even better. Because the 3-fund approach doesn't require you to predict what's coming, it just requires you to stay in the game. Here are the only 3 rules you need to follow. Rule 1, pick 1 ETF from each category I'm about to show you. Not 2, not all of them. 1 per category, that's it. Rule 2, know your timeline. If you're in your 30s or early 40s, you can lean heavier on growth. If you're in your 50s and retirement is getting real, shift more toward income and stability. Your age is the dial, so turn it accordingly. Rule 3, be consistent. The magic in this strategy isn't the funds themselves. It's time. Every dollar you don't touch today is working while you sleep. The people who win with this strategy aren't smarter than you. They're just more patient. ETF number 1, your foundation, VOO. Every great portfolio starts with a backbone, something reliable, something boring, something that just works. That's your foundational ETF. And in 2026, there is no better anchor than VOO, the Vanguard S and P 500 ETF. Here's what VOO does. It buys a tiny piece of the 500 biggest companies in America. Apple, Microsoft, Amazon, JP Morgan, Berkshire Hathaway, all of it in one fund. And when America grows, your money grows too. It's that simple. Think of VOO like owning a tiny slice of the entire American economy. When one sector stumbles, another picks up the slack. If tech is having a rough year, healthcare might be booming, energy pulling back, financials step in. It balances itself automatically. You just hold. Now here's where the data gets exciting. Over the last 10 years, VOO has delivered an average annual return of about 14.3% with dividends reinvested. And in 2025 alone, it returned 17.82%, a year when a lot of investors were convinced the sky was falling. Let's put that into real dollars. Let's say Todd puts $10,000 into VOO today and reinvests every dividend. After 1 year, around $11,430. After 10 years, roughly $38,000. After 20 years, about $144,000. And after 30 years, that single $10,000 investment grows to over $530,000 from one fund that he never touched. VOO's expense ratio is just 0.03%. That's 3 cents for every $100 you invest. Compared to the average actively managed mutual fund charging 20 to 30 times that, and still losing to the index, VOO isn't just a good deal. It's almost unfair. So this is your foundation, the anchor, the thing you set and forget. ETF number 2, your accelerator, QQQ. Okay, VOO is the reliable Honda. It gets you from A to B. It's comfortable, dependable, and never breaks down. QQQ is the turbocharged engine you bolt onto it, the Invesco. QQQ ETF tracks the NASDAQ 100, the 100 largest non-financial companies on the NASDAQ exchange. We're talking about the companies that are actively reshaping the world right now. NVIDIA, Apple, Meta, Alphabet, Microsoft, Amazon, the AI infrastructure build-out, the cloud, the semiconductor boom. It's all in here. Now, QQQ is not for the faint of heart. It swings harder than VOO. When the market sells off, QQQ usually sells off more. But when it recovers, and it always has, it recovers faster and further. That's the trade. More volatility in exchange for more growth. And the growth is real. Over the last 10 years, QQQ has averaged a 19.7% annual return with dividends reinvested. In 2025 specifically, it returned 20.77%. If you had put $10,000 into QQQ 10 years ago, you'd have over $60,000 today. Let's run Todd's numbers here too. $10,000 into QQQ, dividends reinvested. After 1 year, roughly $11,970. After 10 years, around $60,000. After 20 years, north of $360,000. And at 30 years, over $2 million from a single $10,000 starting point. Yes, that number is real. That's what compounding looks like when you give growth room to breathe. One important note for 2026. QQQ has pulled back a bit year to date as tech faces some headwinds, and investors rotate toward value and dividends. That's not a warning sign. That's a buying opportunity. The companies inside QQQ aren't going anywhere. They're the infrastructure of the modern economy. Dips like this are discounts in disguise. ETF number 3, your paycheck. SCHD. Now here's the piece that most people in their 30s and 40s skip and then regret in their 50s. You need something that pays you regularly, regardless of what the market is doing. That's SCHD, the Schwab US Dividend Equity ETF. And right now, in 2026, SCHD might be the most interesting ETF on this list. Here's why. Since November 2025, dividend stocks have sharply outperformed AI and growth-focused tech stocks. There's a massive rotation happening. Money is moving away from overvalued growth names and into quality, cash-generating businesses. And SCHD sits right at the center of that rotation. SCHD holds 100 of the strongest dividend-paying companies in America, businesses that have paid and grown their dividends for at least 10 consecutive years. Think AbbVie, Qualcomm, Procter & Gamble, United Health, companies that were profitable before you were born and will be profitable after you retire. Right now, SCHD yields about 3.99%, meaning for every $10,000 you invest, you collect roughly $399 a year in dividends. And those dividends grow over time. Since its launch in 2011, SCHD has delivered a cumulative total return of 478%. That's a 13.3% average annual return over nearly 15 years. Let's run Todd's numbers one more time. $10,000 in SCHD, dividends reinvested. Year 1, about $11,330. Year 10, around $36,000. Year 20, over $130,000. And in year 30, close to $470,000, with roughly $18,700 coming in as annual dividend income. That's over $1,500 a month in passive income from one fund. Finally, let's talk about the $10 per day portfolio. Now let's put it all together. 1/3 VOO, 1/3 QQQ, and 1/3 SCHD in equal contributions. Simple, clean, yet powerful. But what if Todd doesn't have $10,000? What if he starts with just $10 a day, a couple of coffees, or a lunch he skipped, and splits it across all 3 funds? In year 1, he's put in about $3,650. Not life-changing yet, but watch what happens. After 10 years, that daily $10 habit split evenly across VOO, QQQ and SCHD with dividends reinvested grows to roughly $85,000. After 20 years, over $380,000. And after 30 years, over $1.2 million, with roughly $1,500 a month flowing in as passive dividend income. That's from $10 a day, invested consistently into 3 funds for 3 decades. You see, the people who build wealth like this aren't geniuses. They're not watching the market every morning. They're not chasing trends. They set it up, they stayed consistent, and they let the math work. Here's what I want you to take away from today. You don't need a complicated portfolio. You don't need a financial advisor charging you 1% a year to underperform the index. You don't need to know what the Fed is doing next month. All you need is VOO to anchor you, QQQ to accelerate you, and SCHD to pay you. That's it. Thanks for watching, and catch you in the next one.